Saurabh Mukherjea from Marcellus Investment as well on the show with us. Saurabh, hi, good morning. Good to have you on the show. Saurabh, it seems like the finally much-awaited broader market catch-up is beginning to take place. Do you think we're going to see a material move when it comes to the mid and the small caps? And is it time to increase exposure there?
I think if the Q3 earnings in January, February, if they continue to show the trend that we saw in Q2 earnings. Q2 earnings was revenues coming back somewhat near pre-COVID levels and sharp reduction in costs, around 9-10% YOY reduction in costs, and thus a big jump in operating profits. If that trend continues in Q3, which I think it will continue in Q3. I think you'll see an even sharper jump in operating profits in Q3. Then this broader market revival spreading across small and mid caps, and even in large caps spreading to the sort of less than champion stocks. I think we will continue seeing that. Obviously, all of that will get supported by abundant cheap money sloshing around the global financial system and thus making its way to India.
What are the big bets then, Saurabh, where you think money can be made and across, market caps?
I think the first one, the biggest one, I think is financials. Financials took the biggest pounding through Jan, Feb, March, April, and therefore the call that investors, and I'm sure I'm not the only one, I'm sure there are millions of your viewers who are trying to make the same call, is should we load up on financial services stocks, especially lenders now, or should we wait? Our call is through July, August, September, through these winter months, that buying champion lenders makes a great deal of sense, because we do believe that come next year, Jan onwards, we will start seeing the loan loss recognition from COVID coming through. I did read in Economic Times this morning that the bankers are asking the RBI for another recast. If the RBI gives that, then you postpone loan loss recognition by another 3-4 months. But provided the RBI does not succumb to the bankers' request, I do think you'll see NPA recognition coming through next year. So the call we are making is champion lenders who already done heavy provisioning, raised plenty of capital, will continue to power through the next 2-3 years, and hence we are loading up on high quality financials. But I do know of other investors who are still hesitant on this front. I think this is the biggest call, if you ask me. Should one load up on really high quality lenders now, or should one wait for another 6 months? The Marcellus view is you buy the kings of capital right here, right now, because you want to benefit from a 2-3 year revival in the lending cycle in our country.
Saurabh, if I could probe a little further, high quality financials, could you delve into some of the names, or specifically what area these companies operate in, to get a better idea?
Sure. So historical Marcellus favorites that we have discussed extensively on ET Now over the years have been HDFC Bank, Kotak Bank, Bajaj Finance, and as you would have seen in the Q2 numbers, not only have these lenders provisioned aggressively, they're going into the next calendar year with capital adequacy ratios of 20-25%, right, which should be the envy of almost all lenders. But we've also started building positions in lenders one notch below in size. So, for example, AU Small Finance Bank, since July onwards, we've been building a position there. We'll carry on doing so through the winter months. This is a good lender, especially strong in rural northern India, or rural small town northern India. From IPO to now, over the last few years, the stock hasn't done much, and yet it's a high quality franchise, strong balance sheet, good cost control, good NPA control. So AU Small Finance Bank, City Union Bank, another small bank where we've been building positions through the autumn and through the winter months.
Okay, that's when it comes to the financial cluster. What about some of the other mid caps? I mean, there has been a lot of focus as well on the likes of Pidilite, Page Industries. Walk us through where you're sensing opportunities, Saurabh, because we're really seeing that momentous rally play out within the broader markets over the past month or so, and that outperformance very evident.
Sure. So I think the second big call, if you want to put it like that, is will we see a sustained recovery in consumption, right? Because there's a school of thought which says the current recovery in consumption is just either a Diwali bump or a post-COVID pent-up demand coming through. There are a lot of skeptics out there who believe that we will see a consumption slump through the winter into next year. We don't belong to that camp. We sort of mustered our courage, put on our N95 masks, doused ourselves with disinfectant, and gone out into the field, into the Maharashtra countryside over the past month or so. And the visits we've done, and we've done some post-Diwali as well, the visits we've done to smaller towns in Maharashtra suggest that you are seeing a pretty broad-based and fairly sustainable recovery in consumption. So just yesterday I was in a town 200 kilometers north of Bombay. I'd visited this town before several times, and from what I can make, in spite of COVID, the town is thriving. We must have met 12 retailers. We met the local supermarket manager. We met the local bank managers. There seems to be a pretty broad-based recovery in consumption. So Page Industries, a long-standing Marcellus holding, should be a beneficiary of that. The company itself said that in September, the revenues were up. September versus September, the revenues were up 10%. My reckoning is through October, November, December, Page's revenue growth will accelerate further, especially because of the athleisure segment. Pidilite is a household name. It's been a champion franchise for the last 20, 30 years. Interestingly, when we are going to these smaller towns in Maharashtra, the hardware stores are busier than I've ever seen them before. Actually, we're a little perplexed as to why are the hardware stores and the paint stores so busy. We can't put our finger on it. Clearly, there's a real bustle out there in the markets and the bazaars of our country. And that's what leads us to believe that the consumption recovery will sustain rather than fizzle out.
Okay. Saurabh, we've got the policy coming up. Any expectations this time around, or anything you'd like to hear from the governor?
So I think the die has been cast on monetary policy. I think long back, the RBI made its position, or the Shakti Das RBI made its position abundantly clear. I think 6, 7, 8 months ago, that their focus is on reviving the economy, and I think they'll stick to doing that come what may. Inflation clearly is being ignored. For what it's worth, I support this stance. I do believe that at this juncture, you cannot be, losing sleep about 7% CPI inflation, given that the currency is not under pressure because the balance of payments position is healthy. I think the RBI is right to keep the foot on the monetary pedal. I don't think we'll see a rate cut, but I think the easing of monetary conditions, the easing of money supply will continue. The bigger question, actually, if you ask me, is actually outside monetary policies. When will we get a decisive view from the RBI on bank licenses? The slide of the PSU banks, the slide of the second-rung private sector banks has been evident for 4 or 5 years, and we do need fresh capital infusion in our banking sector. It can come from foreigners, it can come from corporate houses. I think the RBI needs to come up with a clear point of view on that. It's all very well to have learned people opining in editorials of newspapers, but for the economy to power forward, we need a strong banking system, and for that the central bank needs to set out its stall on who will it give bank licenses to in the coming years.
Okay, since you're tracking the financials so closely, Saurabh, would this, spread to, let's say, the mid-tier banks, NBFCs, within NBFCs? Would you slice and dice them a particular way based on some of the industries that are poised for recovery? Would you go deeper into the financials?
So we've said for several years that both the private sector banking space, or the banking space, including PSU banks, and the NBFC industry is set for significant consolidation, right? And in a way, just like the aftermath of Demon, just like the aftermath of GST, I think the post-COVID aftermath will also be a trigger for consolidation. The obvious aspect of consolidation in banking is the PSU banks ceding share to the private sector banks. I think that's an ongoing process that will probably continue for the next decade or so and benefit shareholders in private sector banks. I think that the bigger call is the NBFC industry consolidation. Our reckoning is the NBFC industry will consolidate around, say, a dozen champion franchises, of which we are invested in, say, arguably the strongest of them, Bajaj Finance. But you could argue, you could make an argument for, say, an LIC housing finance as well. Where we are still hesitant to invest is, say, one rung below. We're hesitant yet to, say, invest in a Cholamandalam or a Shriram Transport. But I've met other investors who believe that if the CV cycle recovers, Shriram Transport will do well, and they're therefore investing there. Whichever way you cut it, whether you invest in absolutely the elite NBFCs or one rung below, it is, I think, fairly clear that over the next 3, 5, 10 years, the industry will consolidate, much like private sector banking has consolidated. If you see private sector banking, 4 banks account for 90-95% of the industry's profits. I think we'll see a similar phenomenon play out in the NBFC sector. And if I was an ET Now viewer, I'd be positioning my portfolio to make money from that. Whether you buy a Bajaj Finance or an HDFC or an LIC HF is your prerogative, but it would be a shame if you don't benefit from this consolidation. Just like in private sector banking, I'm very, very confident we'll see NBFC industry profitability crunch in the hands of a handful of lenders.
Speaking of that CV cycle recovery, Saurabh, curious to understand your take on the auto space, because way back in March, you were betting on that strong recovery within the auto space. Do you sense that it has matched expectations, or that there's a lot more steam to go? And where in autos do you continue to have conviction?
Yeah, I think that's a very, very good question. So far so good on the auto recovery. I think the numbers for November also show fairly healthy recovery. As I was just saying, I think the little bit of surprise in the November numbers was the positive print on CV. I think the November versus November's print on CV was plus 3%. And if you're one of those people out there who looks for green shoots in economic cycles, the CV cycle pickup is always the greenest of green shoots. So it's very, very encouraging for anybody who wishes the Indian economy well should take cheer from the print on the CV cycle. Now, the recovery on the auto cycle so far, I think, has been broadly as per plan. Money is cheap. Yesterday, I met several auto dealers who are offering 6.5% for two-wheeler financing. I haven't seen 6.5% two-wheeler financing in my life. I was just blown away. Typically, auto financing, 10% odd, but if you put up, say, a third of the price of the bike, they're giving you 6.5% financing. That sort of thing, I think, will power the two-wheeler cycle and the small car cycle. That, I think, will continue doing well through the winter. The CV cycle, honestly, I'm not yet sure, right? It is early days. Post-COVID, is there really a capex cycle? I don't have any tangible news. We in Marcellus haven't heard any tangible news that a capex cycle is picking up. We are hearing in small town India, the housing cycle has picked up. The small towns that we are visiting, we are seeing renewed activity in residential real estate market, but not enough for us to believe that a capex cycle is underway. So if you're an optimist on the CV cycle, encouraging news, but not enough for us to put money to work.
To be fair, Saurabh, you guys also predicted this gush of liquidity as we see some stability on the virus front, particularly in India. And that's exactly what's played out. Month after month, the FIIs have been consistently pumping money into India. Do you think that this sort of resilience when it comes to the liquidity situation is only going to continue as we do see more updates on the virus and the vaccine, actually?
Easy one. I think the answer to that is an emphatic yes. From March, April onwards, the foreign investor phone calls to us started trickling in, and through the winter, those inquiries from foreign investors have accelerated. And the reason for that is easy to understand, right? If you're a CIO of an American endowment, of an American pension fund, you need to gun out at least 6% to basically, keep your stakeholders happy. If the US 10-year bond yield is at 0%, how will you get to 6 without investing heavily in emerging markets? And if in the emerging market context, Brazil doesn't look to be in great shape. China, their issues there. India becomes the main game in town. So emerging market inflows generally from the Western Hemisphere are running at record levels, higher than, say, the heydays of 2007, 2008. I think 3 weeks back, we saw the highest ever inflows into EM in history, right? So, and obviously, as everybody knows, November was, I think, the heaviest month of EM of inflows into India in Indian history. So this dynamic, I think, sustains because the Western CIO has very little choice but to load up on EM. China issues, Brazil issues, India, the big shining game in town, and we should all hope that the cheap Western money powers the fifth economic recovery in 40 years in Indian economic history. This has been the template for an Indian recovery. Recession in America, followed by cheap oil and cheap money, and that powers the Indian economy into life. Early days yet, but it does look like the beginning of a 2 to 3 year economic recovery in our country, driven by foreign money.
Saurabh, what IT and healthcare are in a bit of a consolidation mode after the fast-paced run-up that they've seen from the March lows. Is there time now to deepen and broaden your exposure to pharma/healthcare? For instance, vaccine logistics is now being looked at. It's going to be the big game changer and the one where everyone's researching their bit. Do you think there are such opportunities within the larger, broader periphery healthcare universe?
So I think, as is evident to lots of people now, the API industry is seeing enormous demand. And remember, I've discussed on your channel that the Chinese API industry is 20 times our size. So as both the Western Hemisphere and India reduces its dependence on Chinese API, we will see shift in API production from China to India. Even if 10% of Chinese API production moves to India, our API industry potentially triples in size, right? And we're seeing the beginnings of that. I think Divi's Lab recently announced a major new capacity expansion, a completely new capex, I think greenfield capex on Divi's part. We're also hearing from not just Divi's, but the entire chemical intermediates chain and people who are right at the bottom of the API chain, people who supply the raw materials for the whole industry, of maxed out demand. Plants are running at full throttle, order books are full. So my reckoning is we'll go through a 2-year, 3-year period where demand for both API and intermediates will outstrip supply. You will thus see not just revenue growth YOY, you also potentially see margin expansion because these companies clearly have pricing power with capacity maxed out. But I wouldn't go overboard in going into second rung, third rung players because capacity will come through, right? The free market will respond, just like Divi's announced capacity. Lesser API manufacturers will also announce capacity, and therefore over a 2-3 year period, the pricing power will ebb away, the margins will come back down. So our preference will be, we obviously want to make money from the whole API boom and the intermediate boom, but we are sticking to our tried and trusted names, which is Divi's at the API manufacturing end, alkylamines as a supplier of ethylamines to this whole industry, and GMM Pfaudler as the almost a monopoly supplier of glass-lined vessels to the space. They're looking for other opportunities. But as yet, these are our bets. IT services, TCS remains our favorite. The economics of IT services isn't as overwhelmingly positive as it is for the pharma space, right? In IT services, the supply-demand mismatch isn't as massive, and Indian IT services should be a key part of any ET Now viewers portfolio. TCS has been our play on this, but I'm sure there are other good names that other ET Now viewers have in their portfolio. I'm not so sure I want to go down the IT services space and play a second-rung company at this juncture.
Fair point. What's the contra call then in the market right now, Saurabh? Has time come to bet on economy-linked sectors? Has time come to bet on real estate, perhaps? Or would you say complete avoid?
I think the contra call always is, I think from a Marcellus perspective, the contra call always is that stay invested heavily in India in champion franchises. This is a country which rewards you very generously for staying invested in champion franchises rather than trying to take profits off the table or running away from the market in months like February, March. I'll never forget that memorable broadcast when I was on your channel. The market went gap down, and I have to confess I ran away from the interview to have a chat with my colleagues as to how much we'll load up. So don't get scared that either COVID has come, let's take money off the the table, or markets run up, left takes profits off the table. That sort of thing is not a clever way to make money in India. And our view has been stay invested heavily, consistently in champion franchises. The Indian market rewards you very generously for that. Our numbers over the last several years are gunning out around 20% returns over several years with low volatility. It's not as if we are buying some highly risky names to generate 20% returns very consistently. We're buying champion franchises and we're making sensible returns for our clients and for ourselves. And I think that is the contra call in India, because there tends to be a lot of noise around investing in our country. It's good to block out the noise and focus on the signal that we've got a country with good companies that can make you and me money.
In fact, on the back of that, we've had a spate of issues as well, and new companies listing even during these last few months. Saurabh, going forward, we've got all this vaccine news that's coming through, all sounding very positive, even for India. Let's say early next year, possibly we'd have a vaccine in hand, and for the private market. Does that mean a further burst of momentum, a further burst of liquidity, Saurabh, given that all signals seem to be go at this point of time? I mean, what are you anticipating as we head in towards the end of the year and are expecting to see a lot more positive news at the start of 2021?
Whilst we are all benefiting from the liquidity, and as I said, whilst we are seeing heavy FII inflows, and let's hope that cheap foreign money powers an economic recovery, we also got to remember that as and when the Western Hemisphere returns to normal business activity, and from what I'm hearing, the UK starts vaccinating people next week. As and when the Western Hemisphere returns to normal business activity, there is, I think, every chance that come say Diwali next year, we could be hearing the Fed play a very different tune. So far, the Fed is saying that we will keep rates close to zero for the next 2 years. But hey, a year from now, if the American economy is booming, maybe the Fed will sing a very different tune. So it's always good to be prudent on loading up on liquidity-driven rallies by focusing on the quality aspect of investing rather than by going into broken balance sheet capex plays. Capex plays in India have a very poor track record of making you and me money, and therefore we've been reticent about going into metals, mining, industrials, real estate, and so on. If you do want to benefit from economic recovery, auto, as we discussed, and financial services are giving you champion franchises which can help you benefit from an economic recovery without giving you sleepless nights with broken balance sheets, repeated issuances of capital, ECB issuances, and all that. So there's a whole murky world of capex funded plays that they're sort of very exciting. They're always in the news. But our job is to make investing boring rather than exciting, and hence we tend to stay away from that.
Just quickly before we let you go, Saurabh, but of the recent listings, including the Burger King one, which is much hype, but anything that piqued your interest, even if you're still perhaps waiting to see how things evolve?
So look, I think we're very happy to see these listings. We've been an advocate for the last couple of years that the exchanges need to do more. The exchanges need to do more to make it easier for high quality companies to list in our country. Otherwise, as I've said before, we've created a benchmark index. We've created a frontline benchmark index which struggles to generate EPS growth even when the country is growing at a reasonable clip, which has been the case over the last decade. So we do need more listings. We're all for the exchanges liberalizing the listing requirements, but we're not a big fan ourselves of loading up on freshly listed companies. Say we wait for the company to be listed for a couple of years. We wait to see clarity on say 8 to 10 years of numbers. So once you're 2 to 3 years in, and you look at the DRHP, add up the track record, and we look to see at least 8 to 10 years of clear financial track record before we put our 4,000 clients as money to work. So I think we've had a good bunch of listings. So I remember looking at the Rosary listing because it's a chemicals company, spec chem company. We looked at Rosary. We'll follow them for the next several years to see how they do. and make a call. So just like, a first day first show movie is very seductive because it's the first day first show, but it doesn't guarantee you it's a classic. And hence if you are a sort of more cautious movie watcher, you give the movie a couple of years, let it mature a little bit, and then you decide whether to watch it at home on OTT platform.
Interesting analogy there, Saurabh. Great to have you on the show and speak with us as always.
Yeah, thank you very much.